Vivian Meranda, Mortgage Loan Officer at Cambridge Savings Bank.
Catherine Chaves, Senior Residential Loan Analyst at Cambridge Savings Bank. So processing means getting an application from the mortgage loan originator, checking it, making sure we have all the information that we need from the borrower, disclosing that file, so that means sending disclosures out. When we get signed disclosures back, we ask for income documentation, asset statements, any other documentation that we may need. Once we receive that documentation, we order your appraisal, your title order, and then we send your file into underwriting after we review and make sure that we have all the documentation that we need. So we basically, from the beginning, make sure we have all the documentation that the underwriter is going to need to decision the loan file. So processing can take anywhere from 30 to 45 days to 60 days, depending on the type of transaction that you have. Typically, we see our refis take maybe like 30 to 45 days. We do have some quick close purchases that can go 30 to less than 30 days. Our mortgage loan officers will work with the borrowers to decide, based on what they're doing, what type of transaction they're doing, how long they should lock their loan for, so we call that the rate lock. So that will also determine how long we're processing your application for. Buyers should expect that we're going to be asking for documentation. We're going to expect it in a timely manner. And if we have any issues getting the documentation, we're going to be reaching out to the mortgage loan officers to get in contact with you to, kind of speed the process up. We like to do this fast, and if that's not happening, then we're going to escalate to the loan officer.
Loan analyst and a mortgage loan officer have to work together because the loan analyst is the one that's going to put the package together to get it through the process. My job as a loan officer is to get the information on the rate and the program and get the lock and make sure the customer has particular expectations. And then when we hand it off to the processor or the analyst, that's their job to do, get the rest of the information, and then it goes to the next step.
Yeah, and we work together because it's just, we have to. We have good relationships with our loan officers, and they're always there for us.
If the loan officer sets it up properly, then they go to the analyst. The loan officer has to set the expectation on what's going to happen. We set it up A, B, C, D, E, what is going to happen through the process, so that when they get to Catherine or one of the other analysts, they understand what she's asking for. And again, if they have questions, we do work together, so they'll come back to, either one of us and ask again.
Customers typically get confused with our loan disclosures, and something that they really hangs them up on is the loan estimate, which is basically a breakdown of estimated fees that they could expect they're going to incur during the loan process. So we always encourage people that if they don't understand, to give their loan analyst a call, or even sometimes give their mortgage loan originator a call if they have any questions based on what they're reading. A loan administration fee is basically a processing fee. We collect $500 upfront once you've signed your disclosures. That pays for any money that's been spent upfront as part of your loan processing. So a credit report, a flood certificate, if we order an appraisal and your deal falls through, or you pull out of your refinance because you're going to another lender, that admin fee is going to pay for any money spent upfront. Typically, a client has to provide W-2s, a most recent pay stub, possibly tax returns if you are self-employed or you have rental income, expenses for any rental properties or second homes, and asset statements like your bank statements, retirement statements if you get a distribution from them. But that's typically all that we're going to ask for.